Hi, elves. When I was a kid, if you told me that one day I'd be able to easily afford to pull off a stunt like this, I would have asked you how much moonshine you had to drink that morning. You see, I used to live just a few blocks from here in West Baltimore, specifically an area called the Triangle of Death. And like a lot of people who live in West Baltimore today, I was raised by a single mother in a housing project with 3 sisters and 1 income. At night, I went to school on North Avenue, which is one of, if not the, most dangerous street in the city. I was also a juvenile delinquent. I did drugs, drank alcohol, and played hooky from school way more often than I went. My friends and I got arrested so often that on the weekends, the local jail kept a cell on reserve for us. They called it the cell for the Eastport boys, named after the neighborhood we grew up in. Baseball was my escape from this life and the dangerous road it was taking me down. And here I am now, at the ripe age of 57, quite possibly richer than King Solomon. I'm in the most beautiful ballpark in America for the entire day. I'm being given a private tour of the bullpen, dugouts, clubhouse, locker rooms, you name it. Heck, after the size of the check I cut to make this happen, the big shots here asked me if I wanted to have my logo up on the club level. But I said no, that's not my style. So why did I jump through all of these hoops, going as far as to hire a full camera crew to follow me around just so I can talk to you today? Simple answer. Even though I got out of the hood, to the coastal elites, I'm nothing but a sheltered, backwards-thinking, feeble-minded troll, a true American redneck. But guess what? The joke's on them. Over the last 5 years, I have annihilated the most respected, most admired, and most accomplished people on Wall Street. I bested them all at their own game. And I did it without getting an MS, MBA, PhD, or any other useless degree. All I needed were my street smarts and a very powerful secret that I'm going to share today for the first and probably only time ever. It's a secret that has made me more effective at making money than anyone else in the country outside of maybe Warren Buffett. And this secret is why I'm undefeated. I haven't taken a loss on a single trade, and I don't plan to either. Here's the proof on your screen. I want you to see this with your own eyes. There are 119 trades in total, and I've closed 32 of these positions so far, and all of them have been winners. Not some, not most, all of them. And as of August 8th, 85 of my 87 open positions are up. My average gain is a monstrous 70%. Not 20%, not 50%, not 60%, 70%. And I owe my success to something I learned from our national pastime. You see, I don't just watch baseball like everyone else. I examine it, scrutinize it, study it, and obsess about it. Since my 21st birthday, I've been to over 650 Major League games. I've learned about every team going back to 1846, and I can give you the name, uniform number, age, and salary for all 750 players in the league. So how has baseball made me, an uneducated, unrepentant redneck, such an unstoppable force? It all has to do with one man, Billy Beane. The name may ring a bell. In 2011, the crackpots in Hollywood made a movie about him called Moneyball starring Brad Pitt. You've probably seen it. If you haven't, the story is now legendary. Almost 20 years ago, a former outfielder named Billy Beane was hired to take over as general manager of the Oakland A's, one of the worst teams in baseball. He was given an impossible task: to recruit a team of players that could win games with a budget 1/3 the size of every other team in the league. Beane couldn't afford to recruit the heavy hitters, the guys who actually fill stadiums. So instead, he hired a statistician from Harvard to help him identify the most underrated, underexposed, and underappreciated players in the league by using something called sabermetrics. Derived from the acronym SABR, which stands for the Society of American Baseball Research, sabermetrics are calculations that reveal hidden strengths and weaknesses of a player. For decades, sabermetrics were ignored and mocked by the elites. The idea of recruiting players based on a bunch of obscure calculations was as foreign as reading a roadmap in Chinese. Team owners relied on tobacco-chewing scouts and recruit guys who could hit the hardest, run the fastest, and throw the farthest. But Billy Beane changed everything. By using sabermetrics, he helped the Oakland A's reach the playoff in 4 consecutive years, from 2000 to 2003. And during the 2002 season, his team won an unprecedented 20 games in a row, setting the American League record. At that point, sabermetrics caught on like wildfire. In 2004, the Boston Red Sox won the World Series using the same formulas Beane pioneered. Then in 2014, the Houston Astros rebuilt their entire team using sabermetrics. Sports Illustrated did a cover story predicting they would win the 2017 World Series. Fast forward 3 years, and that's exactly what happened. The Astros won the 2017 World Series. I realize none of this may mean squat to you. For most people, baseball is nothing but a bunch of grown men standing around spitting and adjusting their jock straps. They'd rather watch paint dry. But I'm not trying to convince you to love baseball or even watch it. This is about showing you how sabermetrics has made me, a former delinquent with a rap sheet for miles, undefeated. You see, several years ago, I figured out something that, as far as I know, no one else ever could. How to use sabermetrics to make money, specifically by using one calculation ripped straight out of Billy Beane's playbook and adapting it for the stock market. And now, by using this single sabermetric calculation, I can identify in seconds stocks that are so underrated, underexposed, and underappreciated that buying them is no different than buying a signed Mickey Mantle card for $5 at a yard sale. Only an idiot would say no. You may want to grab a pen and get out a notepad, or record this next bit on your phone. Do whatever you need to do to process this information, because right now, for the first and probably last time ever, I'm going to show you how I use sabermetrics to outperform, outsmart, and outmaneuver the greatest financial minds working today. When I'm done, you'll have all the knowledge you need to break free from any of the circus strategies you're using now, and instead get the chance to start winning on every trade like I do. No matter what, you will look back at this moment as a defining point in your life. See these formulas? These are sabermetric calculations. In reality, there are 230 in total. Together, they can tell you anything and everything you may want to know about any baseball player, from his walk percentage and strikeout percentage to his speed score, clutch score, and isolated power. But out of all of these calculations, one of them reigns supreme. It's the most well-known, influential, and respected metric in baseball today. It's called WAR. In baseball, WAR stands for wins above replacement. It's a single number that tells you how many additional wins a baseball player is worth to his team. Just to give you a rough idea, the average full-time MLB player has a WAR of about 2. Bench players have a WAR typically between 0 and 1. All-star players have a WAR of 4 to 5, and MVPs have a WAR of 6 or higher. It would take me hours to explain the math that goes into computing a player's WAR. You have to measure all of his on-field contributions, his hitting ability, defensive ability, and base running, and then add adjustments to these contributions based on the difficulty of his position. I don't have time to explain all that, and neither do you. But here's an easy way to look at it. The higher a player's WAR is, the higher his contribution is to his team, the higher his contract price should be. Mike Trout from the Los Angeles Angels, for example, has a WAR of 8 this season, making him worth 8 additional wins to his team. He also costs $34 million a year. Divide that out, and Mike Trout is worth $4.2 million per winning game. That's his cost per WAR, or put another way, what it costs to keep him on the payroll. Blake Snell of the Tampa Bay Rays, on the other hand, has a WAR rating of 5.3, making him worth over 5 additional wins to his team. In comparison, Snell's contract is $558,000 a year. His cost per WAR is around $105,000, which is 40 times less than Mike Trout costs. So I ask you, which player is going to give you more bang for your buck, Mike Trout or Blake Snell? If you answered Blake Snell, then you understand WAR. Identifying players like Snell with a high WAR and a low cost per WAR is exactly how Billy Beane became a legend. Since Beane took over as manager of the A's, the team has won 180 more games than expected, based on the salary for each player. This gives Bean a WAR of 180, making him more valuable than the greatest players of all time. He's exceeded expectations by $1.3 billion. Again, I'm not telling you this for kicks and giggles. I'm telling you this because just like Billy Bean, I too love WAR. The difference is, I use WAR to identify the most underrated, underexposed, and underappreciated players, not in baseball, but in the stock market. And I haven't taken a loss on a single trade. Does that mean I'll never recommend a loser? Well, I'm not God. I can't make promises like that. There's always risk when you're investing. Yes, I'm undefeated. But just like Conor McGregor or Ronda Rousey, I'm also human. I could take a hit. It could happen. However, I've dedicated my life to finding only winning stocks, and I've done extremely well so far. Ask yourself, how many hotshot investors, analysts, traders, or hedge fund blowhards you know who can say they haven't taken a loss on a single trade? I'll tell you how many. None. But I can. Today, I don't spend a second of my life worrying about what the market is doing, who the president is, or how many bozos are out there protesting on the streets about free lunches and gender-neutral bathrooms. All I care about is WAR. And if you want to learn how to become undefeated like me, never forget what I'm about to tell you. Just like in baseball, if a company has a WAR of 6 or more, it's an MVP player, an all-star stock. In a few moments, I'll tell you how I calculate WAR. But first, I'd like for you to take a look at these two charts. The first one is Six Flags Entertainment, which is one of the biggest amusement park operators in America. The other is First American International, a tiny financial firm that provides loans to Chinese Americans in New York City. These two companies couldn't be any more different from one another. Yet, on June 3rd, 2015, both of them had a WAR of around 7. More specifically, Six Flags had a WAR of 7.6, and First American had a WAR of 6.96. With roughly the same WAR, you'd expect both of these stocks to produce the same gains. But as you can see, that's not what happened. Six Flags has gone up 63%, while First American stock has soared like a bald eagle, going up 270%. So why did one company produce returns over 4 times larger than the other? It has to do with their cost per WAR. On June 3rd, 2015, Six Flags had a cost per WAR of 2.9. Meanwhile, First American International had a cost per WAR of 0.86, which is less than 1. The stock was practically a giveaway. So again, if a company has a WAR of 6 or more, it's an all-star stock. But if its cost per WAR is less than 1, it means you can also buy that all-star stock for pennies on the dollar. This is why I've never closed a single losing trade. I only look for companies with a WAR of 6 or higher and a cost per WAR of less than 1. Look at Sanderson Farms. As a guy who loves fried chicken, Sanderson Farms is a household name. Literally, their products line my freezer. They also happen to be the 3rd largest poultry producer in the country. On June 7th, 2013, the company had a high WAR of 14.04. However, they also had a high cost per WAR of 1.8. The stock is now up 63%, which isn't bad. But on that very same day, June 7th, 2013, a tiny no-name company called Mariana Bancorp reported a WAR of 12.16 and a cost per WAR of just 0.8, which is below 1 and far lower than the cost per WAR for Sanderson Farms. So I recommended the company to anyone who would listen. Since then, shares of Mariana Bancorp have shot up 108%. Now, let's talk about Pepsi. Unless you've been living in a bunker, I don't need to tell you how popular a company Pepsi is. Back on May 27, 2016, the company had a WAR of 10.7 and a cost per WAR of 1.63. The stock has since gone up 18%. But on that very same day, May 27, 2016, I found GNBC. Heard of them? I doubt it. I haven't seen a single analyst cover this stock in my entire life, so why would you? They don't even have a website. Compared to Pepsi, this company may as well be an ant living in a giant crater. But it didn't matter to me. GNBC had a WAR of 8.9 and a cost per WAR of 0.9, which is again below 1 and far lower than Pepsi's. So I recommended this stock and told everyone who followed me at the time to buy shares like there was no tomorrow. I hope they were listening. Since then, GNBC stock has shot up like a rocket, surging 194%. Again, if you only target stocks with a WAR of 6 or higher, you'll likely always make money. I've seen it firsthand. But if a company also has a cost per WAR of less than 1, it's like being able to recruit Manny Machado for $10,000 a year. An insane bargain. On December 24, 2014, for example, I found Northeast Bancorp. This tiny, no-name stock has been around since 1872, and yet, as far as I can tell, only one analyst has ever recommended them, just one. But the company had a WAR of 6.9 and a cost per WAR of 0.84. In other words, it was an all-star stock trading at a bargain bin price. So like always, I told as many people as I could to buy shares. For their sake, I hope they listened. When I recommended selling shares, the stock was up 183%. I could do this for hours. By deliberately targeting stocks with a WAR of 6 or higher and a cost per WAR of less than 1, I've managed to crush my competition like Godzilla on a rampage. Not only do I have 119 trades and 0 losers to my name, my wins have been massive. So yeah, I may be a backwater redneck who drives a 1998 Nissan Frontier pickup truck with manual windows, but I'm the only person, to my knowledge, who has figured out how to apply sabermetrics to the stock market, and I'm all the better for it. To date, I'm undefeated. So now, let's answer the big question. How do I calculate WAR for stocks? It took me a long time to crack the code. It was a lot of trial and error, stress, and sleepless nights. Every time I went to the grocery store, even if I was with my grandkids, I grabbed a few bottles of wine just to keep me from losing my sanity. And after a few years of number crunching, I finally cracked it. It would take all day and into tomorrow to explain all the intricacies of the WAR calculation, but I can sum it up in a few sentences. I start by adding up everything a company owns and subtracting everything they owe. Next, I scrutinize the trend in a company's financial accounts from one year to the next to see if it's profitable, growing its cash flow, reducing its debt, increasing its assets, and generating more sales from those assets. I then put the company through a credit strength test to determine its debt levels, how many cents they generate in earnings for every dollar of assets they own, and their efficiency in delivering sales from those assets. The sum of these variables is then divided by the company's market cap, debt, minority interest, preferred stock, and cash positions. And that's only half the battle. Remember, if a company has a WAR of 6 or higher, it's an MVP player, an all-star stock. But I'm only interested in buying all-star stocks at bargain bin prices. That's why I always calculate a company's cost per WAR before I even touch it. To calculate cost per WAR, I combine a company's market cap, debt, minority interest, and preferred stock, and then subtract that sum by whatever cash the company has on hand. The final number is divided by the firm's earnings before interest and taxes for the trailing 12 months. So as you can see, computing a company's WAR and cost per WAR is no walk in the park. However, I can tell you from personal experience that nothing is more effective when it comes to making money. Not momentum investing, not technical investing, not bond trading, not after-hours trading, not weekend trading, not short selling, nothing. For fun, I went back and ran the performance of all WAR stocks from the past few years. Look at what I found. Back in 2011, exactly 162 stocks had a WAR of 6 or higher and a cost per WAR of less than 1. And of these 162 companies, 159 are now up in price. Do the math. That's a 98% win rate. Even better, the average gain for these stocks is an absurd 212%. Some of these stocks are up as high as 571%, 634%, and 691%. In 2012, 143 companies had a WAR of 6 or higher and a cost per WAR of less than 1. Of those 143 stocks, 141 are now up in price, 97 of which have gone up by triple digits, with some producing gains as high as 488%, 602%, and 906%. The average gain is 158%. Let me remind you, these are not options gains. They're stock gains. That's how real investing is supposed to work. You buy a stock, it goes up, you make money. Plenty of promoters, analysts, and traders will try to convince you otherwise. They'll tell you that buying stocks is ancient history, yesterday's news. But these are the same yokels that pump cryptocurrencies like drug peddlers and try to talk you into risking life and limb on penny stocks that are worth less than a can of Diet Coke. It's complete and utter BS. They only say these things because they are terrible investors. So they have to do everything and anything they can to distract you from their lack of talent, even if it means telling you to execute some insane trade that can rob you blind in minutes. I don't have that problem. In August 2013, 98 companies had a WAR of 6 or higher and a cost per WAR of less than 1. And of those stocks, 95 are now up in price, the vast majority by double and triple digits. In July 2014, 88 stocks had a WAR of 6 or higher and a cost per WAR of less than 1. Today, 85 of those stocks are up in price. Again, the vast majority by double and triple digits. I'm only showing you these results so you can see with 4K HD clarity that when you know how to compute a company's WAR, like I do, winning can become second nature. In August 2015, 72 companies had a WAR of 6 or higher and a cost per WAR of less than 1. Today, 70 of those companies are up in price, nearly all of them by double and triple digits. In August 2016, 74 stocks had a WAR of 6 or higher and a cost per WAR of less than 1. Today, 69 of those companies are up in price, exactly 66 of them by double and triple digits. Have you ever seen anything this incredible? I doubt it. Even over the past year, while the market has been as jagged as a chainsaw blade, 32 of the 37 stocks that had a WAR of 6 or more and a cost per WAR of less than 1 have gone up in price. During this same period, only 54% of all stocks have gone up. So you know what? If you want to follow a bunch of storm chasers or dump your money into a secret lithium mine in Africa or some kind of super drug that can cure every disease known to man, goodbye, good luck, and Godspeed to you. I hope you obtain rapid success. I've just shown you 7 years of proof that by using WAR, like our friend Billy Bean, you don't have to jump through hoops anymore. You can stop throwing your money down a rabbit hole to nowhere. You can instead buy stocks and go to sleep at night, like I do, knowing that your wealth has the potential to grow faster than Jack's Beanstalk. Look at Green Dot, for example. The company sells prepaid debit cards in about 100,000 convenience stores nationwide, including CVS, 7-Eleven, and Walgreens. They basically designed a product for the financially impaired. That is, people who run up their credit cards despite having no money to pay their bills. Green Dot is not a revolutionary business by any means. But when I found this company in May 2014, I saw that it had a WAR of 6.3 and a cost per WAR of 0.21. It was just like I had found Derek Jeter's 1996 World Series bat selling in an antique shop for $100. So I told everyone who would listen to buy up shares. Since then, the stock has been on a non-stop joyride. The price is up over 350%. Or let's talk about Malibu Boats. This obscure business builds specialized boats for water skiing, wakeboarding, and wake surfing. Not exactly the most popular sports, but that didn't matter. When I found this company on July 29, 2016, it had a WAR of 7.39. It was an undiscovered gem. And because the stock also had a cost per WAR of 0.75, I knew this gem wouldn't stay undiscovered for long. Today, those shares are up 182%. Then there's John B. Sanfilippo & Son. Unless you live in the South and enjoy eating pecans out of a can, you've probably never heard of them. They sell nuts in grocery stores. Not exactly the type of business that makes headline news. But on February 22nd, 2012, I noticed something no one else did. Despite making only $2.8 million a year in profit, John B. Sanfilippo had a WAR of 8.1 and a cost per WAR of 0.96. So again, I recommended that the folks buy up as many shares as possible. Since then, John B.'s price has jumped an obscene 623%. Not 62%, not 162%, 623%. But I digress. There's something I haven't told you that I need to get off my chest. Yes, it's 100% true. As far as I know, I am the only undefeated individual in this entire industry. Again, this doesn't mean I can't lose. Buying stocks is never risk-free. But the proof is in the pudding. I've yet to close a single losing trade, and I don't plan to. And the reason I've been so successful is not just because I love baseball. It's not just because I've read thousands of books on finance and economics. It's not just because I use sabermetrics, specifically WAR, to find winning stocks. It's because I focused my attention on some very specific subsectors of the market. One of my favorite overlooked, marginalized, and forgotten subsectors of the market is banking. Yes, I said it, bank stocks. More specifically, community bank stocks. I know how boring that sounds, but before you decide to shut this video off because you think small bank stocks are below your pay grade, consider these facts. Fact number one, banks are indispensable. Without banks, we wouldn't have loans to buy a house. Without banks, we wouldn't have paper money to buy things we need. Without banks, we wouldn't have cash machines to roll out money for us on demand. Without banks, we wouldn't have that shiny new toaster we got for opening an account. Fact number two, unlike 99% of other businesses, banks always get paid, not only from the interest they charge their customers, but from transaction fees, overdraft charges, mortgage fees, trading fees, and a laundry list of other sources. Fact number three, banks are protected. Due to new federal regulation, they are required to undergo regular stress tests to ensure they always have enough cash to survive losses in case of another financial crisis. This protects not only the banks, but the shareholders of those banks as well. Fact number four, there are a lot of bank stocks. About 1 out of every 10 stocks is a bank stock. There are 838 of them trading on U.S. exchanges right now, and a whole lot more around the entire world. Does this mean all banks are invincible? No. But if a bank has a WAR of 6 or higher and a cost per WAR of less than 1, it's like finding a ruby crystal under your pillow. You'd be crazy not to cash in. Just look what happened on a single day, January 25th, 2015. That day, 4 bank stocks came on my radar. Each had a WAR of 6 or higher and a cost per WAR of less than 1. Now, look at how far they've traveled since then. Together, they've amassed 453% total gains. Again, not to sound like a broken record here, but all of my closed trades have been winners. All of them. I haven't lost money on a single bank stock, not a single one. And unless the Stay Puft Marshmallow Man decides to level Wall Street tomorrow morning, I don't anticipate that will ever change. This is what it takes to be undefeated. Discipline, determination, and a painstaking obsession with detail. If I have to scrutinize every number on every SEC filing that a company has ever made until I feel comfortable enough betting my life that the stock will go up, then that's exactly what I'll do. This isn't a side job or hobby for me. It's my livelihood. I don't buy into hyperbolic nonsense. I don't listen to 30-year-old MBAs who think that because they took a class in microeconomics, they know the future. No one. I don't care if you're a wizard with enchanted powers or Warren Buffett's third cousin. No one can predict the future price of a stock. If anyone tells you otherwise, ignore them. There are no magic rings, flying monkeys, or mystical unicorns on stock charts that tell you when to buy and sell shares. These are nothing but gimmicks created by lazy people who have zero talent, big egos, and the attention span of a 4-year-old. All I care about is one thing: winning, pure and simple. Small bank stocks have made me rich beyond belief, and I have no doubt they will continue to be the market's most prized assets. I say that for many reasons. First off, under President Trump's new tax laws, banks are about to see their taxes slashed from 30% to 18%. Then there's the new Dodd-Frank rollback bill, which allows banks with assets under $250 billion to be completely free of current oversight requirements. Lastly, because the Fed is on a mission to shrink its balance sheet, interest rates will very likely rise for years to come. This means profitability on loans could increase tenfold, which is nothing but fantastic news for banks. Now, I hate quoting the media, but even the doofuses at CNBC now admit that banks are entering a true nirvana here on Earth and are about to do very well for a long, long time. So no, bank stocks are not sexy. They are not in the news. They're not trending on Twitter. They're boring as all hell. But so freaking what? If boring means never having to lose money, if boring means having an average gain of 70%, like I do, then I'll happily engrave boring on my tomb. Banking is just the first of 4 subsectors I target in the stock market. I'll tell you about the other 3 in just a little bit. First, let me say that harnessing sabermetrics to uncover these diamonds in the rough has made me richer than I ever imagined. Long gone are the days where I had to wash dishes in the back of an old diner just to make rent, or sell Electrolux vacuum cleaners door to door in the frigid cold just to put food on the table. Today, I live on a palatial Florida estate right next to Disney World. From my back porch, I can see the nightly fireworks, and I don't have a care in the world. I'm living proof that while not everyone can become a great investor can come from anywhere. But I'm done talking about myself. This isn't American Idol. I'm not trying to win a popularity contest. I'm doing this for one reason and one reason only. It's 2018, and I shouldn't be the only undefeated American in the stock market. Sure, it's great for bragging rights. I love that I can claim superiority over all those egomaniacs on TV who think they own the seas because they ran a hedge fund at some point in the last century. Whoop-de-freaking-do. You gambled with other people's money. Congratulations. The fact is, I'm sick and tired of watching millions of Americans get suckered into bad investments. I can't read a single article, blog, or op-ed without being subjected to a bombardment of bad information spewed from the mouths of bad analysts, bad forecasters, and bad journalists. It makes me nauseous. So I'm taking a stand. I want to fight back against an industry that I believe is filled to the brim with propaganda ministers, amateur artists, and tired has-beens. For once in my life, I want to help other people. People who are losing money on stocks because they're being fed a continuous stream of bad advice all day, every day. Look, I could go on for hours, but time is of the essence, so I'll make this quick. Sabermetrics is a methodology born from the simple idea that you should never judge a book by its cover. It's about looking past the perceived flaws of a player and identifying talent and skill that others cannot see. And it's been proven to work, not just in baseball, but elsewhere as well. In 2008, Barack Obama used sabermetrics during his campaign to rally individual voters. In 2014, the San Antonio Spurs used their own version of sabermetrics to win the NBA championship. That year, they were named the best analytics organization in the country by MIT. In 2017, the owners of the NHL's newest hockey team, the Las Vegas Golden Knights, used sabermetrics to assemble its roster of players. Later that year, the team made it to the Stanley Cup Finals. Today, Hollywood producers are also using the principles of sabermetrics to create hit movies. Even the military uses their own form of sabermetrics to combat insurgencies, chiefly in Afghanistan and Iraq. And now, it gives me great pleasure to announce the unveiling of my own investment research service. Baseball, a heat seeker, is a crushing line drive, a fast, furious, an extremely effective hit that can easily put a player on second or third base. As someone who has produced one winning trade after another, I consider myself to be a walking, talking heat seeker, a person who hits relentless line drives every time I come up to bat. Once a week, that's 52 times a year, I'm going to give you a new sabermetric stock recommendation based on a company's WAR and its cost per WAR. But I'm not going to bore you with long-winded dissertations. Instead, I will be communicating with you via live, uncensored video broadcasts. Every Monday morning, I'm going to send you a link, delivered if you choose both to your cell phone and email. Click on that link and you'll be redirected to a live video broadcast where I'll reveal a new sabermetric stock recommendation and discuss why I've picked it. But be warned, this isn't the Mickey Mouse Club. I have a loud mouth. I don't talk in PC language. I don't care who I offend. My weekly video broadcasts are raw, uncensored, and uncut. Aside from giving you a sabermetric stock recommendation each week, I will spout my political opinions. I will gossip about baseball. I will criticize celebrities. I will say anything I want about anyone I want at any time I want. Don't worry, if you don't want to watch my videos, you don't have 52 stock recommendations over the next year. And if you can't already tell, I take enormous pride in my success, which is why I'm extremely picky about where I put my money. I have to be. My undefeated status means everything to me. I will never risk anything to lose it. So I treat every investment like a life or death situation. At this point, nothing could be more harmful than a losing trade. That's why if I'm not comfortable putting $1 million of my own money into a stock, I won't recommend touching it, not with a 10-foot pole. And I'm only interested in applying my WAR methodology to certain subsectors of the market, areas I've personally had a ton of success in, and although I don't have a crystal ball, I plan on keeping up the pace. Number 1, high-flying banks. Before I recommend a bank opportunity, it must have a WAR of 6 or higher and a cost per WAR of less than 1. Since we've already delved into bank stocks, let's move on to division number 2, which is prime takeover targets. These are small businesses with large cash reserves, low debt, lots of equity, a solid distribution network, a clean capital structure, low overhang, expandable margins, minimal litigation risks, inside ownership, and a ton of prized assets. To a large company like Amazon, GE, or Ford, these kinds of businesses are like hot donuts out of the fryer. You want to eat as many as possible, as quickly as possible. That's why owning shares in them is, and always will be, such an effective way to make money. Because whenever one company wants to buy another one, it has to pay shareholders in that company a premium to what their stock is currently worth. Otherwise, they won't agree to a deal. This is what causes these stocks to explode. On December 22, 2017, for example, when cancer giant Roche agreed to buy early-stage drug developer Ignita for $1.7 billion, Ignita's stock blasted up by 72%. On January 17, 2018, when biotech giant Celgene announced it was putting in a bid to buy out Juno Therapeutics, Juno's stocks popped up by 55%. But identifying these prime buyout candidates is easier said than done. You have to know how to evaluate a company the same way a corporate rater would, by knowing the company's debt, growth rate, and credit scores. But that's where WAR comes in handy. It gives me an edge when looking for stocks that are most likely going to be taken over next. On December 26, 2015, for example, Pure Industrial REIT, a trust that owns 25 million square feet of commercial real estate, reported a WAR of 7.7 and a cost per WAR of 1.4, which is just slightly above where I'd normally like to be. But I knew, for many reasons, this company would soon get gobbled up. And it did. The stock was acquired by Blackstone, and the stock soared 203%. Then, in January 2016, an engineering and construction firm called TRC Companies reported a WAR of 10.7 and a cost per WAR of 0.81. Within a year, TRC was purchased by a large investment fund, and the stock went up 98%. These are just two examples. By using WAR, I've repeatedly identified the market's most vulnerable buyout candidates, like a marksman looking through a Barrett 50 caliber sniper rifle. HealthNet, Span America, Outer Wall, Tecumseh Products. Each of these stocks had a WAR of 6 or higher and a cost per WAR of less than 1. And as you can see, they didn't just go up, they exploded. Next up, we have division number 3, which is indispensable operations. I will also be using WAR to identify underrated, underexposed, and underappreciated companies that provide essential services to the U.S. economy, indispensable operations. We're talking about businesses that own and operate vital infrastructure operations, things like airport, toll roads, water systems, bridges, pipelines, oil and gas facilities, landfills, and alternative energy programs. What sets these companies apart is that 10, 20, even 30 years from now, they will likely still be in business, making money, and expanding their operations. Look, I don't have to tell you that we can't drive without bridges, we can't fly without planes, we can't throw away trash without landfills, and we can't consume energy without gas or alternative resources. These companies provide essential services to our day-to-day lives, and by calculating their WAR and cost per WAR, I can identify which of them is perfectly primed to experience an immediate jolt in price. Look at what happened over the course of just a single year. On April 28, 2012, I found Star Group. They own a fleet of 2,500 transport vehicles and service vans that supply heating oil and propane to 455,000 customers. With a WAR of 7.2 and a cost per WAR of 0.7, I knew this company wouldn't stay in the shadows for long. And I was right. The stock is now up 165%. On March 9, 2012, I found Chase Corporation. They own and operate 16 manufacturing sites that produce everything from natural gas lines and cover tapes for semiconductors to concrete protectorants and control joint systems for bridges, stadiums, and airport runways. The stock had a WAR of 11.7 and a cost per WAR of 0.85. Today, shares are up an astronomical 787%. Then, on June 19, 2013, I found Argan, a holding company whose subsidiaries own gas power plants, solar facilities, wind farms, biofuel plants, and environmental facilities all across America. The stock had a WAR of 9.84 and a cost per WAR of 0.14. Since then, shares have gone up as high as 368%. These were not options gains. I recommended these companies, the price went up, and anyone who was smart enough to follow my advice made a crap ton of money. That's real investing. That's how it's supposed to work. Just like with the other divisions, before I recommend a stock in this division, it must have a WAR of 6 or higher and a cost per WAR of less than 1. That's the rule. And finally, we have division number 4, top dollar real estate. This is where I'll recommend real estate stocks, primarily REITs. Now, why does a redneck like me love REITs? One word: cash. REITs own large baskets of commercial properties that pay insane amounts of income. Office buildings, apartment complexes, storage facilities, industrial sites, hospitals, hotels, shopping centers, etc. To me, owning these stocks is like being a real estate mogul. Only instead of buying a ton of property with your own money, you can buy shares in REITs and get paid on the real estate they already own. Obviously, not every REIT is worth investing $1 million in, and I won't recommend any stock I'm not willing to put $1 million of my own money into. Some of these companies own dead retail spaces, vacant shopping centers, and low-rent properties with awful tenants. But that's where my WAR calculation comes into play. By using WAR, I can identify REITs with low leverage, low debt, strong governance, solid franchise value, a portfolio of high-paying rental properties, a near-perfect credit rating, and are trading at or below its net asset value. This number is critical because if a real estate company's share price is trading at a discount to its net asset value, it means you can buy its income-producing assets for less than they're worth on a per-share basis. It's like buying a multi-million-dollar home for pennies on the dollar. Just look at what happened over a single year. On March 29, 2015, I found Preferred Apartment Communities, a developer that owns 94 commercial property and luxury apartment units. Its WAR was 7.6. Its cost per WAR was 0.77. Today, the shares are up 111%. On March 31st, 2015, I found Stratus Properties, a developer that owns hotels, condos, and retail properties in Austin, Texas. Its WAR was 7.5. Its cost per WAR was 0.87. Today, the stock is up 114%. On September 16, 2015, I found Rexford Industrial Realty, which owns 177 properties in Southern California. Its WAR was 20.4. Its cost per WAR was 1. Shares are now up 137%. And on June 10, 2016, I found Pico Holdings, which owns several water storage facilities in the Southwest U.S. Its WAR was an incredible 23.1. Its cost per WAR was 0.63. Today, the stock is up 97%. Again, every morning, be on the lookout for my next live, uncensored video broadcast.